back to our special series, What the World Wants from India. We have with us Maasry, who is Head of Portfolio Strategy at Goldman Sachs International. He specializes in emerging markets. Caesar, thank you very much for joining us in this show. Well, first up, a more general trend question to you. We have been seeing from November 8th a long DM and a short emerging market trade. It seemed to fizzle out a few days back with the dollar receding from that 103 levels. But should we worry that the first half or even the entire 2017 will still be a long DM, short EM trade?
Yes, hi. Thank you very much for having me. I guess the first question I would say is, in general, it's been quite supportive of equity markets globally, part of the whole reflation and cyclical uptick that's supported also by actual fundamental data. On the point of allocation between the developed world and emerging markets, we do think that actually starting the year, the reflation trade will continue, which does favor the developed markets. Let's say in the first half of the year, as rates rise, we do think the dollar will continue to strengthen. But looking at the second half of the year, we think actually fundamentals in EM are starting to look quite a bit better, notably outside of China. And actually, we think it will be quite a good second half for emerging markets.
Okay, but in the first half itself, we have seen a decent amount of outflows from November 8th onwards from emerging markets. And India has had more than its share of outflows. How does that trend look to you? Say in the first quarter of 2017, will FIIs continue to pull out of EMs, especially India?
So I think across other emerging markets, actually the flow trends look a little bit better in the recent term. And as I said, on an absolute basis, we actually do see emerging markets doing relatively okay in the first half, perhaps not as well or not as strong as developed markets. I think in the case of India, it was a little bit idiosyncratic given the demonetisation, which did sort of spook some of the foreign investors. But I do believe that that's quite a short-term phenomenon. And again, as we look at the second half, we'll get back to sort of a better emerging market story. I think sort of in the very near term, of course, the market is very focused on policy, political uncertainty, certainly around the U.S. and potential trade policy. That tends to spook investors about emerging markets as well. But presumably we will get a bit more clarity on this issue in really the very near term, in the coming weeks specifically.
Yes, clearly there has been an underperformance of India vis-a-vis emerging markets and perhaps a little more outflows out of India because of demonetization. Is that underperformance at an end, or will it continue?
So that, I do think, is closer to the end. I think the economic impact of demonetization was a little bit unclear, of course, from a couple months ago. But already the very recent data looks like the deceleration has already started to improve. That is to say, the latest batch of data was a little bit more supportive in India. And therefore, I think foreign investors will look again at the underlying fundamental trends. And frankly, more broadly across emerging markets, I think one of the larger complaints over the years has been the lack of reform. And in India's case, this is, I think, a medium to longer term positive story. We just needed to get over the very short term uncertainties about economic impact, which I do think are receding.
Okay. Well, let me ask you about the budget itself. What are you expecting?
I'll defer to our Indian economists about that. Again, I'd say broadly across emerging markets, there actually has been some concern about fiscal issues. However, those I think are much larger outside of India, more in places like Latin America. And in general, we are quite supportive of EM sovereign debt. But in India, we don't see it as being a particularly stressful issue.
Okay. Well, actually, the problem with India has not really been fiscal deficit or excessive government borrowing. In fact, the government has decided to borrow less than it originally planned. It has cancelled some of the borrowing programs. But the worry has been with respect to the interpretation of certain tax rules, especially with respect to indirect transfer of assets. Has those concerns hit you? Are you worried about those interpretations?
So frankly, not so much. I mean, clearly there are uncertainties. There always have been, particularly for foreign investment coming into India. But what I would stress as a broader strategist, the most important factor that we see moving the emerging markets in the current cycle has absolutely been the underlying growth story. And it is in that sort of theme that India really has outshone its peers. We do think it will continue, not just at the macro level, but actually if you look at underlying earnings. And one of the specific themes in India, I think, which is important to note, has been the ongoing NPL cycle, which really started basically a year ago. And that is, again, unique because when you look at other emerging markets that have seen excesses in the domestic sort of cyclical areas, particularly the banks, they've not gone through an NPL cycle. And ultimately, I believe this paves the way for a stronger domestic growth story. And that, frankly, is what equity investors, as well emerging market investors, tend to look for overweight positions.
There is a fear that long-term capital gains in India on equities are exempt from tax. The fear is that long-term may be redefined not as 1 year, as it is currently done, but perhaps as longer than 3 years. If either of these happen, would you worry?
Again, I think those are things that add to risk premium in the domestic market. But when we look at the flows, and you mentioned sort of institutional fund flows, FIIs earlier, when we look at foreign flows into emerging markets, the amount that comes into India is actually very correlated with the amount that comes into places like Brazil, Taiwan, Turkey, Russia, across the emerging market complex. It really does trade as an asset class. Now, you also had referred to sort of an extra amount of outflow coming from India really in the fourth quarter, which I would very much, again, relate to fundamentals. So while individual corporate tax or capital gains tax type plans do impact at the margin when they're announced, really when you look at the course of 1 quarter, 6 months, over a year perhaps, it's much more about the broader allocation question. And again, from that perspective, I'm much more constructive on the emerging markets. I think we focus too much on just what happened in the past, few weeks or few months. And if I just expound a little bit more upon this, one of the questions earlier was about developed market performance versus emerging market performance. And yes, we saw that trade favor developed markets in the last couple of months, but that occurred during a period when U.S. interest rates surged very aggressively, something like 100 basis points in just a couple of months. And that is a big driver for global capital allocation, for the dollar strength, and so on. I think those are the much bigger issues to focus on, even when we're looking very specifically at India and potential foreign flows. And for all the reasons sort of outlined earlier, I do think the balance of risks shift from being a negative one to emerging markets and India specifically to a positive one really over the course of this year.
Well, what's your view on the rupee? There are some people who have worried that it has been unusually stable, even too strong. Would you anticipate a weaker rupee?
So our forecast is actually quite close to where the spot is. We think the rupee will trade at about 68.5 versus the dollar at the end of this year. It is true the rupee has been quite stable, even more so than I think a number of the other emerging market peers. But again, I would argue that if you look at the cycle, one of the undoubtable fundamental improvements across emerging markets has been the improvement in the current account balances. And I think India is a shining example of that. That's somewhat old news. I think that's been sort of the story for the last couple of years. But now broadly, the emerging market complex as a whole has improved along that metric, which adds a stability broadly again to emerging markets. But in India's case specifically, we haven't cut rates so much. Inflation has come down. I think there is the ability of the central bank to cut rates maybe another 25 basis points this year, again supporting some of that domestic cyclical growth story. So I'm not looking for a whole lot of volatility, I think, in the rupee. And again, we go back to the conversation from earlier that if foreign inflows come back in more so on the equity side, that should also support the currency.
Okay. Well, if you are expecting, high single-digit growth from India in FY18, would you worry that valuations are already high, expensive in India? And a related question, therefore, what kind of equity returns are you expecting in the next 12 months or say 24 months from Indian equities?
Yeah. So on the 12-month basis, again, we think the multiple, which you touched on, and I'd say broadly across equities is an issue. But anyhow, in India's case, we have a target of 9,000 on the Nifty. So that's basically in line with where we think earnings growth will be. Again, calling for a relatively flat multiple. But going back to your point on a stretched valuation, I think that is clearly the biggest risk for all equities. It's not just India. It's also the S&P, a number of other emerging markets that trade at quite high multiples. And of course, the big debate across the equity landscape is, can these equity markets maintain such elevated multiples in the context of higher interest rates? Of course, it comes down to the balance of how much do rates go up relative to sort of the growth improvement that one sees. But again, relative to other equity markets, I think India is well placed among its peers.
Right. On that positive note, Caesar Maasry, it was a pleasure listening to you. Thank you very much for joining us and for also that very optimistic note you struck on Indian equities.
Thank you very much for having me. My pleasure.